Have you ever wondered why some investors seem to succeed while others constantly struggle? The answer often lies in avoiding common pitfalls. Warren Buffett, one of the greatest investors of all time, has seen it all. Today on No Money, we're diving into the top 10 mistakes that investors make, mistakes that even the pros aren't immune to. By learning from Buffett's wisdom, you can avoid these errors and build a stronger financial future. Number 1. Holding cash too long.
When you look at the future, there's also the argument made that this is something that goes with your philosophy today. Get out of cash and get into assets, because we don't know what's going to happen to the dollar.
Well, cash is always a bad investment. I mean, when people said cash is king a year ago, I mean, that's crazy. I mean, cash wasn't producing anything, and it was sure to go down in value over time. And then you always want to be sure you have enough. I mean, it's like oxygen. You want to be sure it's around, but you don't need to have excessive amounts of it around. And cash, we will always have enough cash around. But anytime we have surplus cash around, I'm unhappy. I mean, I would much rather have good businesses than cash. And we found a chance in the last year or thereabouts to deploy. We came in with something over $40 billion in cash,
right,
and we've got about $20 billion now, and we've had some earnings. So we put a lot of cash to work, and I like that. No, I'd much rather own a good business than have cash.
Warren Buffett has always been clear. Money should be working for you, not sitting idle. At Berkshire Hathaway, holding excess cash is something he actively avoids unless he's unable to find a worthy investment. Buffett believes in putting money into companies that offer long-term growth potential rather than holding cash for the sake of security. His famous quote, "We'll never employ it just to employ it," captures his belief that cash should be actively invested. The idea is simple. Cash depreciates over time due to inflation, so having too much cash lying around can be detrimental. Instead, find good companies to invest in and put that money to work. Number 2. Trying to time the market. Many investors fall into the trap of trying to time the stock market, buying low and selling high. But according to Buffett and his partner Charlie Munger, this approach is risky and unnecessary. They don't try to predict market movements. Instead, they focus on finding fundamentally strong businesses. Buffett's philosophy is that nobody can consistently predict short-term market swings. Rather than trying to guess when the market will go up or down, Buffett advises concentrating on finding companies with good long-term potential. As Munger puts it, we don't know, and we won't know. Number 3. Over-diversification. Diversification is a safety net that's often recommended to reduce risk. However, Buffett argues that if you know what you're doing, owning too many stocks can dilute your best investment ideas. He's famously said, "If you know how to analyze businesses, it's crazy to own 50 or 40 stocks." Instead, Buffett advises focusing on a few companies you deeply understand. When you invest in businesses you're confident in, over-diversifying can spread your resources too thin, leading to average results. While diversification reduces volatility, it can also limit the potential upside of your best investments. Number 4. Misunderstanding risk. Buffett's definition of risk is losing money permanently, not short-term price fluctuations. Many investors confuse market volatility with risk. In reality, risk arises when you don't understand the business you're investing in. If you invest in companies without fully grasping their competitive advantages, management, or long-term potential, you're putting yourself at risk. Buffett advises looking beyond the stock's day-to-day movement and focusing on whether the business itself is solid. Risk, according to him, comes from ignorance, not from volatility. Understanding what you're investing in can help you sleep easier during market ups and downs. Number 5. Forgetting to invest in yourself.
By far the best investment you can make is in yourself. I mean, for example, communication skills. I tell the students that come that they're going to graduate schools and business, and they're learning all these complicated formulas and all that. If they just learn to communicate better, both in writing and in person, they increase their value at least 50%.
One of Buffett's core beliefs is that the best investment you can make is in yourself. He consistently emphasizes the importance of improving your skills, knowledge, and abilities. Whether it's learning how the stock market works or improving communication skills, Buffett believes that self-investment pays the highest returns. He often tells young people that improving their skills can increase their value by up to 50%. After all, having the right tools and knowledge will always make you a better investor. So, before diving into the stock market, consider investing time in learning and growing. Number 6. Relying too much on intelligence. You might think investing is all about having a high IQ or advanced mathematical skills. Buffett disagrees. He believes that having the right temperament is far more important than intelligence. In fact, he attributes his success not to a high IQ, but to patience, discipline, and a calm temperament. He's often said, "You don't need tons of IQ in this business." The key to successful investing is keeping emotions in check and staying rational, even when markets get volatile. Intelligence may help in analyzing data, but a steady temperament ensures you stick to your strategy. Number 7. Following asset allocation models blindly. Many financial advisors preach the importance of asset allocation, recommending that you invest a certain percentage of your portfolio in stocks, bonds, or other assets. However, Warren Buffett dismisses this rigid approach, calling it total nonsense. Instead, he believes you should invest based on where you find value, not just follow a predetermined formula. Buffett argues that sticking to fixed percentages can limit your ability to seize opportunities when certain investments are undervalued. For example, if stocks are trading at attractive prices, he would allocate more to stocks rather than follow a set allocation plan. The key is flexibility. Buffett's strategy is to go where the value is, regardless of traditional allocation models. He warns that blindly following these models can result in missed opportunities and diminished returns. Instead of sticking to percentages, focus on identifying good investments and allocating your capital wisely. Number 8. Day trading. The allure of day trading is hard to resist for many, but Buffett warns that it's more akin to gambling than investing. Short-term traders often speculate on stock price movements without considering a company's true value. This behavior, in Buffett's eyes, is a recipe for disaster. Instead of getting caught up in daily market fluctuations, he advises focusing on long-term value. If the stock exchange were to close for years, would you still be comfortable with your investments? That's the question Buffett asks himself, underscoring the importance of focusing on a company's fundamentals, not its daily price swings. Number 9. Chasing growth stocks. Growth stocks may seem tempting because they promise fast appreciation, but Buffett approaches them with caution. Growth, in his view, is simply one factor in determining a company's value. He prefers to analyze whether a business will produce greater cash flow and appreciation over the long term, not just the speed at which it grows. Growth for the sake of growth doesn't always result in good returns. Buffett looks for businesses where growth aligns with value. A company that grows rapidly but doesn't generate significant returns on investment can be just as risky as a declining one. Number 10. Waiting for the perfect market conditions.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are. But if you think you can jump in and out, or that you know the time to come in, I think you're making a mistake.
Some investors make the mistake of waiting for the perfect time to buy, hoping for a market crash or a correction. Buffett believes this is a flawed approach. Instead of waiting for a better deal, he says it's better to buy great companies at fair prices. Waiting indefinitely for the market to drop could mean missing out on long-term winners. Buffett's strategy is to invest in companies with a strong track record and future growth potential, regardless of whether the market is at an all-time high or low. As he says, it's better to own them than wait for the perfect opportunity that may never come. Warren Buffett's investing wisdom can be boiled down to a few simple yet powerful principles. Avoid unnecessary risks, invest in what you know, and stay patient. These 10 mistakes that many investors make serve as valuable lessons for anyone looking to build wealth over time. Whether you're a seasoned investor or just starting, taking Buffett's advice to heart can help you navigate the complexities of the market. If you found this video helpful, make sure to like, subscribe, and hit the notification bell for more insights from No Money. Don't miss out on the chance to learn more about investing and financial success. Thanks for watching.